Okay, thank you. All right, microphone's working. I must say this is the first time I've given this paper with so much technology involved, but I appreciate the conference organizers inviting me to present today. So this paper has fairly straightforward motivation to it. When we think about the two forms of debt financing that firms use, the most common ones are loans and bonds. Now, we have extensive academic literatures on firms' capital structure decisions. We have a lot of work out there on how firms decide which type of debt to use. We have some outstanding work on aggregate quantities, fluctuations in loan and bond issuance over time. Now we have an extensive literature on the pricing of corporate bonds. We have this immense credit spread literature that tries to apply structural and reduced form models of credit risk to explain the credit spreads that we observe on bonds. There's also some work out there on loan pricing, but the work on loan pricing tends to take a much different tack. So the work on loan pricing tends to look at specific contractual features, such as if the loan is from a constrained bank versus an unconstrained bank, how is that affecting the credit spread on the loan? But there's a complete dearth of work on how the pricing compares between these two markets, or how credit risk is priced in the loan market compared to how it's priced in the bond market. And so that's the gap that this paper is going to fill in the literature. And so the questions I'm going to address in this paper, first and foremost, how are loans priced relative to corporate bonds? Or specifically, how much does it cost controlling for credit risk, sort of per unit of credit risk? What is the credit spread on a loan versus the credit spread on a bond? Now, relatedly, there's a little work out there on how seniority is priced in credit markets. We don't really know whether our existing models of credit risk reflect how seniority is priced in the credit markets, primarily because there's not a lot of variation out there in seniority within the corporate bond market, which again is where the literature tends to focus. And so I'll provide new evidence on how seniority is priced in the corporate credit markets, both in the loan market as well as some new evidence from the corporate bond market. And finally, one takeaway from this paper is it provides a quantitative measure of how much firms are willing to pay for the benefits that bank loans offer. We know from the literature that there are many benefits to borrowing from a bank or issuing a loan relative to what you would get from issuing a corporate bond in the public debt markets. And so the numbers that I'll present today can be interpreted in that light as well. Now I want to provide some intuition for the approach I'm going to take today. The challenge, if we were to just say, all right, let's look at all of the loans out there and all the bonds and compare their credit spreads, is that there are a lot of observable and unobservable differences between the types of firms that borrow in the loan market and borrow in the bond market. And so Duffy and Singleton have a fairly simple sort of framework to think about. It's not a simple framework itself, but they come up with a fairly simple sort of model of how risky debt should be priced in the end. And what they come up with is that the credit spread on a zero coupon risky bond should be equal to the risk neutral mean loss rate, or the risk neutral probability of default, Q, times the expected loss given default, L. Now the solution I'm going to take to the problem that I'm studying today is to construct a sample of loans and bonds from the same firm, observing them at the same time. And the advantage of this is going to be that this Q, this probability of default, is going to be the same for both the loan and the bond under standard cross-default provisions. And so the difference in credit spreads between the two instruments is going to depend only on their relative expected losses given default. Now let's look at some evidence on loss given default and see sort of the effects of priority when we look at actual outcomes when loans and bonds default. And the key thing to keep in mind here is that these are debt instruments, and so the difference in the payoff, any sort of variation in the payoff, is really only going to be depending on what happens in the event of default. Now what this plot is showing are kernel density estimates of recoveries for loans and bonds, as well as the firm level recoveries for firms that had both secured term loans and unsecured bonds outstanding at the time of default between 1997 and 2017. These are the types of firms that are going to be in my sample today. And so these firms have very similar characteristics to the loans that we're going to be pricing. Now what this is showing, first the blue dotted line is showing that firm level recoveries are sort of fairly evenly distributed. Firm level meaning the total amount of firm value that's distributed for the total amount of debt that was outstanding at the time of bankruptcy. The average here is about 55 or 60%. Now, when we apply absolute priority, where the loan is senior and the bond is junior, we see a big difference in the recoveries for these two instruments. And so if we look at the red solid line, we see that loans recover 84% of what they're owed on average, but you see huge skewness in this. They're recovering everything they're owed, including accrued interest, in almost all of the cases that we observe here. Now, the bonds are junior to the loans. They get what's left after the loan gets paid off. And so the bonds have recoveries that are more like 35% on average and a somewhat more even distribution, but with more weight on the left-hand side, closer to zero recovery. And so what this is showing, if we sort of interpret these recoveries, the average loss given default for loans is 16%. The average loss given default for bonds is 65%. And so the simple prediction from Duffy and Singleton, assuming that the risk premium on recoveries is the same for loans and bonds, and this is something I'll dig into a bit later, we would predict that bond spreads should be about 4 times as large as loan spreads, because the loss given default for the bonds is 4 times as large as it is for the loans. Now let's look at the pricing of loans and bonds. So this plot, and the previous plot, give a sense of sort of the main empirical takeaway of this paper. A lot of the effort going forward will be just to quantify this and try to take a stab at explaining it. So what we're looking at here are non-parametric regressions of credit spread on the y-axis on a measure of distance to default. This is the naive distance to default from Barath and Shumway. The intuition here is that 0 essentially represents insolvency. The firm is not actually in default. I don't have any bankrupt loans in my sample. If we look at a distance to default of about 6, that's about a double B rating. 9 is about a triple B rating. And 12 is about a single A rating. Now the data here and the sample I'm going to be using in this paper are new loans to firms that have bonds outstanding. I'm going to place some maturity restrictions. I require the maturity to be at least 3 years. I require a maturity difference of less than 2 years between the loan and the bond. And this is going to be all loans that are issued over 1997 to 2017 that satisfy this criteria. When we look over on the left-hand side of the graph, we see a fairly intuitive picture. So we see the bond spreads are much higher than the loan spreads. They're not quite 4 times as high as the loan spreads, but they're significantly higher than the loan spreads, as we would expect given the recoveries in default. Now what's interesting, and what sort of got me digging into this question, was when we look at firms that are reasonably financially healthy, so firms that are double B, triple B, single A rated in this sample. And what we see is that the credit spreads on the loans and the bonds, to be perfectly clear, by the way, the credit spreads, the loans, these are the all-in drawn spreads on the loans relative to LIBOR. These are floating rate instruments. The bonds, I'm quoting the spreads relative to the LIBOR swap curve. And so if we wanted to swap the loan into a fixed rate instrument, we'd use exactly the swap rate that we're using for the bond. So there's no basis in the benchmark here. And what we see for these reasonably healthy firms is that the credit spreads are indistinguishable from one another. So the lenders are receiving the same credit spread that the bondholders are getting, except they are far more protected in the event of default. And so what this indicates to me is that the loans are earning a very attractive return, or the cost of issuing a loan, controlling for credit risk, seems to be higher just based on this evidence alone. And so what we've seen, and give you a sense where we're going, bank loans seem to earn a premium relative to the bond market implied price of credit risk. Now I'm going to apply a structural model of credit risk, as well as the reduced form Duffy and Singleton framework, to try to quantify the magnitude of this premium. And what I'll find is that this premium, this loan premium I will call it, relative to what the bond market implies the loan should earn based on its credit risk exposure, in a sample of secured term loans, this premium is between 140 and 170 basis points, or between about 45 and 60% of the observed loan spread that we're seeing in the data. So in other words, about half of the loan spread is credit risk as though it's priced in the market. The other half is some compensation above and beyond that. Now, what are the economics of this? First of all, I used the model, and we'll get into some of this in detail today. It's all in the paper. This is too large to be explained by cost of financial distress. We need excessively high bankruptcy costs or excessively low assumptions about recoveries to generate the loan prices that we see in the data. It can't be explained by differences in the fixed costs of issuance between the loan market and the bond market. We need to assume excessively high costs of bond issuance to generate this result. and it can't be explained by illiquidity in the loan market. It's not the case that this is just a liquidity discount, and this is why we're seeing this big difference in pricing. Now, I'll also show you today that an extreme risk premium on recoveries is necessary to explain this. So when the loan is impaired, this is sort of farther in the left tail of firm value than when the bond is impaired. And so one concern is that we have some sort of low probability event risk that's being priced or some systematic risk. I'll show you that if we make the most extreme assumption possible about the risk premium in the event that the loan is impaired, that's essentially what we need to generate the spreads that we actually observe in the data. Now finally, I'll show you evidence that within the corporate bond market, seniority is actually priced about as we would expect under this Duffy and Singleton framework. And so this difference in pricing from what we expect based on relative recoveries is really specific to loans. It's not due to the inability of our credit risk models to explain the pricing of a senior debt instrument. Now the data I'm using in this paper, I mentioned, these are new loans to firms that have bonds outstanding. Now I want to be perfectly transparent about where the sample is going to be coming from. And to be perfectly honest, I'm taking a chainsaw to the data to get this sample that's going to give me this clean comparison in pricing. And so I want to go through the steps I'm taking, and then I want to give you a couple of pieces of evidence on the external validity of this study and provide some support for the idea that these results should generalize to other segments of the loan market. So if we start with DealScan CompuStat over the sample period I'm looking at, we have about 30,000 loans. Now I exclude loans where we have poor data quality. I exclude certain types of loans that are associated with major corporate events, debtor in possession loans, loans that are used to finance LBOs or mergers and acquisitions, loans that are sponsored by private equity firms. That gets me to about 17,000 observations. Now, the key step where I'm losing stuff is when I match with an unsecured bond issued by the same firm. As we know, most firms do not have access to the public debt markets. It's about the top fifth of CompuStat firms that are actually issuing corporate bonds. And so most of the firms that we see in DealScan are not also bond issuers. And so we don't have this public market counterfactual that we do for the firms that are going to be in my sample. Now when I impose some maturity restrictions, again, I don't want to be comparing a 30-year bond to a 1-year revolving credit facility. I don't think that's going to be very informative about how the revolving credit facility should be priced. That drops about another half of the observations. Now, one key piece of information I want to give is that if I apply the same assumptions that I'm going to apply in the framework I'll explain for pricing term loans, if I price these 3,300 loans, if I just ignore maturity, if I include revolving credit facilities, I find the same results. But what I'm going to do is restrict to term loans because the term loans don't have this drawdown payback option that's embedded in a revolving credit facility that's somewhat difficult to value in sort of our existing models of credit risk. When I restrict to term loans, that again drops about 80% of my observations. Now I'm going to require the term loan be secured by a first lien on most or all of the assets of the firm. This will ensure that there's no ambiguity about which instrument is senior in the event of default. Now finally, to apply my model, I need some data on the debt structure of the firm. I need to know how much outstanding bank debt there is, how much outstanding debt total there is. You'd be amazed actually if you look at the Edgar filings for some firms early in my sample. There's no information whatsoever on this. So I've actually hand collected all the information that we can for the firms that are not covered by Capital IQ. This gives me about 200 loans. Now again, this is what I'm going to focus on because this gives me the cleanest comparison possible. If I assume the same things for revolvers, I'll end up with similar results. Now a key piece of context here, and I mentioned this, compared to the DealScan universe, these firms are going to be larger and more creditworthy because again, these are the large CompuStat firms that have access to the public debt markets. Now, the benefit of this sample construction, and I hope my explanation of the intuition made this clear, is that this gives me a clear comparison of how the two instruments should be priced, free of any firm, time, unobservable characteristics. But of course, the problem with this is that this sample is not representative whatsoever, and so I want to provide some evidence on the external validity of this study in a few different ways. So first, if we look at sort of what's going on with the firms when they're issuing this debt, one question might be, are these firms shut out of the bond market? Is that why they're going to the loan market? Now, first of all, and it's not on the slide, but one key point I want to make, if we look at the rating changes since the issuance of the bond that I'm using for my sample, It's essentially symmetric. The average, there's been no rating change. There are some that have been upgraded. There are some that have been downgraded. The firms, if we look at their profitability, if we look at their equity returns, they're performing well over the last year. Very few of the firms are experiencing operating losses. Most of them are earning positive equity returns on the order of about 15% on average. And all of these firms are rated. Most of them go on and issue new bonds in the future. About a quarter of them issue a bond over the next year. About 3/4 issue bonds over the next 5 years. Firms don't issue bonds that often, and so that provides some support that sort of the typical firm in my sample remains having access to the bond market. Now, in terms of the pricing of these instruments, I want to make sure that there's nothing unusual about how these loans are being priced or how the bonds are being priced. So first, this plot is showing, again, a similar plot, credit spreads on distance to default, but it's looking only at loans. It's looking at loans to firms that have a credit rating that would qualify for my sample, and loans to firms that do not have a credit rating that would not make it into my sample. They're not bond issuers. And what we see, perhaps unsurprisingly, is that the loans to the non-rated firms, conditional on credit risk, have higher spreads than the loans to the rated firms. These firms have a worse outside option. They potentially have greater unobservable credit risk, and so they pay a higher cost to borrow in the loan market. And what I would take away from this is that, if anything, I would expect my results to be stronger if I were able to estimate them on this outside sample of non-rated firms. Now, if we look at the bond spreads of the firms that are in my sample or not in my sample, firms that do or do not have a new loan, and if I look at firms that do or do not have a loan outstanding at all, we see a similar picture. The bond spreads conditional on credit risk are essentially exactly the same. So there doesn't seem to be, on an observable basis at least, anything particularly unusual about the firms in my sample. And importantly, they do not seem to be in desperate need of debt financing or sort of overpaying for the loan financing that they're getting, which of course could generate my result in itself. Now, to quantify this premium, what we've seen so far indicates that the level of loan spreads seems high relative to what the bond market implies. Now, one interesting piece of evidence is that if we look at cross-sectional variation in loan spreads, so if we regress loan spreads on leverage, asset volatility, credit rating, we can actually explain about 70% of the cross-sectional variation in loan spreads. So it's not the case that the loan spreads are being determined by something completely unrelated to credit risk. In fact, we can explain most of the variation in the cross-section, the relative pricing of loan spreads, using basic credit risk variables. What seems to be off is the level of the loan spreads relative to how things are priced in the bond market. And so what I'm going to do, encouraged by this idea that the loans do seem to be priced on the basis of credit risk in the cross-section, is apply existing models of credit risk, a structural model of credit risk. I'm going to apply this to estimate bond-implied loan spreads. So what I'm going to do is I'm going to take the bond spread from the same firm, I'm going to push this through the model, and this is going to give me a counterfactual loan spread as though these cash flows were being priced in the public debt markets instead of in the syndicated loan market. Now, what the bond spreads are going to offer is essentially risk-neutral default probabilities. They'll offer sort of a parameter for the firm value process that will generate this. And then I'll use different assumptions about recoveries to sort of provide support for the robustness of these findings. Now, the two objectives here: first, measure the loan premium in excess of what the bond market, how the bond market would price these cash flows. And second, to quantify the frictions that would be necessary to explain the pricing of loans that we observe in the data. Now, when we're thinking about risky debt pricing, there are sort of three main considerations we should have in mind. First, what's the probability of default? How likely is it? And when is this going to happen? Second, what is the recovery in the event of default? And third, what is the systematic risk exposure of both of these things? What's the risk premium on the default probability? What's the risk premium on the recovery? What states of the world are these going to happen in? Now, the advantage of my setting is that default is occurring at the same time for the loan and the bond in each sort of loan-bond pair that I'm looking at. And so this essentially shuts down the first channel. It also shuts down the systematic risk aspect of the default probability channel, because we have cross-default on all of these debt instruments. And so the model of recoveries is going to matter a lot here. I'm going to pay a lot of attention to that. I will also provide evidence on the risk premium associated with recoveries, because again, it may not be the case necessarily that the bond market provides great information about the states in which the loan has a very low payoff. Now, the model I'm going to use, the model I'm going to focus on, is just an extension of the Merton model. I'm trying to keep the framework as parsimonious as possible, but I'm going to have some add-ons that will try to get at the attributes of the loan market more closely. And so we have senior debt and junior debt in the model. Absolute priority is going to apply. These are just going to be valued as options on the value of the firm's assets. And what I'm going to do with this model is I'm going to use the bond price, or the bond spread, to back out the implied volatility of the firm value process. And then I'm going to apply the senior debt pricing model to get a counterfactual value of the loan, or a counterfactual credit spread. Now, one issue with these types of models, we're all probably familiar with these from our PhD coursework, is that this assumes a log normal process for firm value, and this has thin left tails. It's not going to do well at matching the recoveries on loans, because the loan as a senior instrument we can think of as essentially being a farther out of the money option than the bond. When the loan is impaired, this is way in the left tail of the firm value distribution. And so I'm going to apply a few different assumptions about recoveries that will have support either in the literature or in the empirical data. And this should help ease concerns about the ability of the model to match the recoveries that we actually see in the data. And so the first approach I'll use is sort of the proportional bankruptcy cost that we see in Leland-style models. And the cost I'm going to use is going to be based on Brent Glover's estimation of bankruptcy costs to firms that have or have not defaulted. And so he estimates bankruptcy costs about 45%, that are a bit lower for firms that endogenously choose to have higher leverage. This, again, is going to be a proportional firm-level bankruptcy cost. So if the firm defaults, the firm value is going to drop down by the proportional amount of this bankruptcy cost. Now, the second approach I'm going to use is, instead of using a closed-form solution of the model, I'm going to actually simulate the model. I'll simulate whether the firm defaults, and then I'll simulate the recoveries that the debt holders get in the event of default. This is essentially the approach that the rating agencies use. And the distribution of recoveries that I'm going to use is based on the empirical distribution of firm-level recoveries that we saw in the data that I showed you earlier. And so what I'll do is I'll draw a firm-level recovery if the firm defaults, and then I will apply absolute priority to distribute value to the loan and the bond. Now finally, I can also just use the simple Duffy and Singleton Q times L framework, and I will find similar results. The advantage of this framework is that it doesn't actually take a stand on the absolute priority rule. It doesn't matter whether absolute priority applies or not. We're just going to get the expected recovery from the data. The one underlying assumption of this, and the underlying assumption of both of these frameworks as well, is that the ratio of risk neutral to physical loss given default, or the recovery risk premium, is going to be the same for both loans and bonds. And again, this is an assumption that I will address shortly. Now, there are some additional aspects of loans that do not fit into this framework directly that are important to account for here, or additional aspects of the empirical setting that I'm looking at. So first, loans are prepayable at any time. So this is one of the advantages of loans, actually, that firms will cite if you talk to the CFO of a firm. They like that they can pay down the loan at any time without any penalty, whereas bonds, there will be some callability provisions, but typically you just have to wait till maturity and make all the coupon payments up until then. Now, the nice thing is that we have derivative pricing models that we can use to value this prepayment option. Specifically, this is a swaption on the firm's loan spread because the base rate on the loan is floating. Now, I estimate this in the paper, and I find that the value of prepayment is about 30 basis points on average, which is in line with the difference that we see in the spreads on callable and non-callable bonds once we account for the fact that the loans are senior to the bonds, and this should have somewhat less value for the loans than it does for the bonds. Now, the second thing I'll account for are issuance costs. I'm using primary market loan spreads and secondary market bond spreads. And so the bond spread won't be a perfect reflection of what the primary issuance spread would be if the firm were to issue a new bond at the moment in time that I'm looking at. Now, in my sample, I see that the issuers of bonds are paying about a 3% fixed cost to issue a bond, about a 1.5% fee, about a 1.5% discount. This is on the high end for high-yield bond issuing firms. But I'm going to apply this issuance cost, and what this does is it adjusts up the bond spread that I'm putting through the model to estimate counterfactual loan spreads. And so I'm going to account for this issuance cost directly. Now, what I can do also is look at how big the issuance cost has to be to explain the loan spreads that I see in the data. How expensive is it for the firm to go issue a bond? Could that explain what the pricing of loans is? We need a bond issuance cost of about 24%. So the firm has to issue the bond at 76 with a principal value of 100. This seems ridiculously high. Does not seem like a real potential explanation for what's going on. Now finally, I can account for illiquidity in the model. Transaction costs in the loan market may be higher than they are in the bond market. In fact, if I look at bid-ask spread quotes for the loans that I can observe secondary market pricing for in my data, they're actually quite similar to what we see in the bond market. And so I don't adjust for this in the baseline model, but what I can show is that a liquidity discount of about 10% is what's necessary to be explaining the pricing of loans that I'm seeing in the data. All right, so let's look at what the estimates are from this model. Again, I'm calling the loan premium the difference between the observed loan spread and the loan spread that the model generates, or that the bond market would generate. So first, in the top two rows here, we're looking at the bond spread and the loan spread that we actually observe. The bond spreads are slightly higher than the loan spreads, but they're not too far apart. Now, if we plug these bond spreads into the model, under the bankruptcy costs model, we see a model spread of about 108 basis points. Under the simulated recovery model, rather, we get a model spread of about 140 basis points. Now, what this implies is a loan premium of 140 to 170 basis points. Now, to put this in terms of economic magnitudes to make some more sense of this is about 45 to 60% of the loan spread that we're observing in the data. Most of the loan spread is premium in excess of what we see in pricing in the bond market. If we look at this in terms of dollars, this is about $10 million per year for the median firm, about $20 million per year for the average firm, or about 2% of the EBITDA of these firms. So it's a non-trivial amount in economic terms that these firms are paying in excess of how credit risk is priced in the bond market. And for what it's worth, the reduced form model leads to very similar estimates. Again, all these models are using very similar intuition in terms of how credit risk should be priced. Ooh. All right, so if we revisit our plot from the beginning, these lines are just reflecting the estimates from the model. Again, across the credit spectrum, we see that the bond market is implying lower loan spreads than what we're seeing in the data. If we look in the time series, this red line is the loan spread. These are the counterfactual estimates. Now, I should point out, most of the observations we're seeing are in expansions. That's because I'm looking at loan originations. We didn't see really any loan originations during the financial crisis. I would love to be able to show you a plot where the loan premium just spikes like crazy during the financial crisis. I'm working on getting secondary market data so I can do exactly that. But what's important to notice here is that the loan premium, the difference between these lines, is large across the whole sample period. And what's interesting to me is that it remains quite large today during a period when we actually see the loan market and the bond market starting to have very similar contract terms and very similar investor bases. And so there does seem to be some real segmentation between these markets, or there's some real benefit that the firms are paying for on these loans. Now, there are many excluded features of loans, fees, discounts, covenants. Exclusion of all of these is just leading to underestimate. It's either underestimating the cash flows the bank is getting, or I'm overestimating the actual risk of the loan in the framework I'm using. I want to provide some evidence now that the model is actually equipped to price senior debt. I'll show you some evidence on the risk premium necessary to generate the result I'm seeing, and the pricing of secured and unsecured bonds. So first, if we look at the simulated and empirical distributions of loan recoveries, again, these are kernel density estimates. These are now just the loan recoveries here. We see the model matches the data fairly well. Now, what we might be concerned about is over here, the bond is receiving no recovery. And so what we might suspect is that the bond spreads are not very informative about the states of the world where the loan sort of recovers not quite par or recovers essentially zero way over in this left tail. And so one exercise I do in the paper is to say, all right, let's assume the worst in terms of state pricing over this region where the loan is impaired. Let's assume that the Arrow de Brue prices over this range are zero, or that there's no value to the lender of the payoff over this range. And if I apply this sort of framework, if I apply this adjustment to the model, this is similar to what Koval, Jurek, and Stafford do in their paper on AAA structured products. We see that then we can actually match the loan spreads we see in the data. So now we get loan spreads that are sort of indistinguishable from what we see in the data. So if we assume that lenders place no value whatsoever on the states where the loan is impaired, that could be one explanation for what we're seeing. Again, I find that to be unlikely, but that's one thing that we could do to match the data. Now, if we reframe the picture I showed you at the beginning, so now we're looking at the bond to loan spread ratio. Remember, we expect this to be about 4 based on loss given default. By credit rating bucket, we see that to the left side here, we have a ratio of about 2. Then we have about a 1-to-1 ratio for the investment grade firms, Again, this is surprising given the seniority of loans. Now let's look at secured and unsecured bonds. So I construct a very similar sample of secured and unsecured bonds using secondary market prices for both. Same firm, same date, similar maturity. Now if we look at the loss given default ratio, we should expect a ratio of about 1.33 for these spreads, the unsecured to secured bond spread. And what we see in the data essentially matches that exactly. The ratio is 1.4. Now I want to make a couple comments on sort of the economics of what's going on here. First, it does not cost more to borrow from a bank. The interest expense for these two things is similar. What I'm showing is that the return to the lenders seems to be very attractive relative to the risk that they're bearing. Now the way we can interpret this, unfortunately it's very difficult to pinpoint an explanation for what's going on, but we can think of this loan spread as splitting the economic surplus that's generated by the loan between the borrower and the lender. We know from the literature that loans generate some economic surplus through all the other benefits that the loan could offer to the firm. The question is whether the bank is sharing some of that surplus, which would be evidence of imperfect competition in the loan market, or whether the firm is capturing all of the surplus and the bank is just passing through the costs of producing this loan to the firm. One final thing. All right, sorry, John. I will end. I think this raises questions about competition in this market. It's unclear that we have good models of how competition should function in this market structure. Thank you, guys. Sorry, John.